Hey everyone, Coach Investor back to another video for today. So in today's video, I have the honor to host Brian Stoffel on the channel. If you remember, not so long ago, we had Brian Feroldi. If you missed that video, that would be in the top right corner. We also had many other people on the channel, so be sure to check out the interview playlist. So in today's video, we talk about Brian's journey throughout the years when it comes to investing, some good mistakes, some bad mistakes, some recommendations for books, highest convictions, talk about leadership, etc. So if you're interested in that, obviously sit back and relax and enjoy this video. Would really appreciate it if you hit that thumbs up button and subscribe if you have not. So without further ado, enjoy. Why did you start investing? What brought you into the investing world?
So I never meant to be in the investing world. In fact, being involved in finance in general would be the last thing, like literally the last thing. I think if you came to me in high school and said you're going to be in the circus when you grow up, that would have been more believable than me being involved in finance. Because I grew up in a very I went to a very diverse high school, and it was very clear to me that more money did not mean better life. Obviously, there is a certain level of resources you need. And so I wanted to be a high school English teacher. I ended up being a middle school writing teacher for a number of years. And I ended up getting involved with finance and stocks and things like that because my wife and I, we retired from teaching just before we turned 30. And we decided we needed some free time. We moved to Costa Rica with no jobs, no plans, but we had savings. And while we were there, I had to roll over. I took it upon myself to roll over our 403Bs, our retirement plans from teaching. And when I did, I didn't have any clue what I was doing. And I found the Motley Fool to help me with it. And I loved it. I loved the way that they talked about money in a way that I was not familiar with. And it exposed me to money being a tool I thought of it as a necessary evil. And they said it can be, but it can also be a tool to help you get what you want. And what I wanted was just freedom of time. And so why do I invest today? It's because I believe it gives me an opportunity to have that freedom of time, which is really, 10 years ago, the freedom of time was just kind of to pursue activities. Today, I've got two kids that are under 10, and I get to spend my days with them. I do my work from home, so I'm able to do that. So I wouldn't trade that.
Yeah, for sure. For Costa Rica, I've heard it's a wonderful place. It's on my list to go visit. So that's very nice to hear. Now, what are the lessons you learned from, let's say, 10 years ago when you started? Start with the Fool. Did you write for the Fool as well?
So I wrote on the boards a lot, and then I saw that there was an opening for a new writer development program, and I applied. I was accepted. I spent 6 months at the Fool headquarters, and then I spent the next pretty much up until the pandemic contributing regularly to Fool.com and also writing things for the premium services. So today I don't do Fool.com anymore, but I do premium services. I'm on Motley Fool Live. And then my partner, Brian Feroldi, and more recently, Brian Withers, we combine to do some things outside of the Motley Fool, but covering many of the same topics.
Yeah. And what made you choose to to go on YouTube and start the YouTube journey?
It's really funny because it's gone well so far. But the Motley Fool started this program called Motley Fool Live right as lockdown started because they wanted a way to communicate with their members. And this was a way to do that. And all of us were stuck at home. So why not? Right. And Brian Feroldi and I were two of the first people to sign up for it. And we came up with this show called Stocks from Scratch. And it was all about how to teach me 10 years ago, middle school teacher, no finance background whatsoever, to show how you can actually do this, how you could research a stock from scratch. We loved doing it. We're also contractors and we're both extroverts, and we don't get a chance to interact with people that often. So the chance to do that was really fun. Now, as Motley Fool Live got more mature, they had to pare down what shows they had. And so our show got cut for a while. And so Brian just said, do you just want to keep doing it? And we can just do it on YouTube. It's just a way to hang out, and who knows, maybe people will like it. Honestly, it wasn't much more than that. And so the fact that we have, I don't know, 62,000 subscribers today is crazy to me, because it was just a way for us to keep hanging out and having fun. But I'm glad to see that people are responding to it too.
For sure. I think it's funny, the correlation between how the YouTube channel started and then how you started investing as well. I think it's a lesson to learn, because I still believe that most retail are scared of investing. They think investing is scary, pretty difficult. But when you use tools like the Fool or YouTube, which obviously YouTube is a great way to learn for free, you start seeing that, well, it's not that scary and it's not that difficult to understand. Of course, it really depends how you view things. If you go for trading, if you go for the long-term investing, then two different worlds. But I do feel that more and more retailers should view investing as, it's not a scary movie. It's actually a pretty cozy journey if you really have a long-term vision, if you know what you're doing.
I like the way you use that, a cozy vision. I think that one thing that all of us who can do what we do can do better is trying to remember what it's like to sit in someone's shoes who this is brand new to, because we can start using terms like PE ratio, something as simple as that to someone who's involved in investing. When I was getting started, if I heard that, my eyes would have glazed over and I would have been like, yeah, I'm done. Like, I don't know what that means, and I have no idea why it's important. It can be really hard to remind yourself of that on a regular basis, but I also think it's really necessary.
Yeah, for sure. I mean, one of the reasons I called my channel Couch Investor is because of that, because I do feel that if we are more and more couch investors, I wouldn't say laid back, because at the end of the day, you're still investing your own money or your family's money, but trying to understand a way to invest in a more natural language than in PE ratios or in EVs and stuff like that is probably a better way to go. Of course, after that, you can always go deeper and deeper. Now, I do want to touch on something very specific to you and to the other Brian, is the anti-fragile evaluation of stocks. So how was it, like, when did you start inventing it, let's say?
Yeah, so two things happened at about the same time in 2015. I believe it was 2015. But there's two events that happened. And the first event was that David Gardner, the founder of the Motley Fool, ran a service called Supernova. And in it, there's a group of Motley Fool people who voted on a group of 5 stocks, which stocks should win and get an investment every month. And actually, it was 10 stocks. And what quickly became clear to me was that if I didn't have a way to organize my thoughts around this, it was way too much work to go through and find out everything I needed to about 10 stocks every month and do everything else I was doing. It was just too much. So I had to come up with a system to digest that information and make a decision without taking all my time away. Now, that's the first thing. The second thing that happened at the same time was that I picked up the book Anti-Fragile by Nassim Nicholas Taleb. And basically, it talks about how we usually separate the world into 2 categories: the fragile, things that break when exposed to chaos and stress and time, and the robust, things that don't break when exposed to chaos and uncertainty and stress and time. And he says there's this third category that we aren't talking about, but we should. And those are things that get stronger when exposed to stress and uncertainty and chaos and time, up to a point. And that's the anti-fragile. So our muscles, our immune system, when you lift weights, it's not actually lifting of weights that makes you stronger. It's the rest and them growing back stronger. That's where the real benefit happens. And what I tried to do was take the basic outline of what he talks about in that book. And, he didn't play a role in this. This is just my interpretation of this and applying it to looking at companies. Which companies are set up such that they will get stronger when exposed to time and stress? Because I was listening to Morgan Housel podcast just last night, and he said something that is so true, and it now is seared into my brain after reading Nassim Taleb's work, which is we are terrible at accepting the fact that we cannot predict the future. Nobody in January 2020 was thinking about coronavirus. Nobody in January 2022 was seriously considering that there would be a major war in Europe. And nobody today on November 4th, 2022 is thinking about what the major thing will be in 2023 because we don't know what it is. And that can be very scary to not know what it is. And I think that the idea of anti-fragility is like an antidote to it. So what I'm attempting to do is to measure these companies and say, based on everything I know today, in an uncertain future, are the scales tipped ever so slightly towards this company succeeding or towards them failing? Doesn't mean I'm predicting the future or even trying to. I'm just trying to say, how fit are they to survive in an uncertain future?
Yeah, no, fair enough. I think for those listening or watching, Psychology of Money is one hell of a good book. I think I read something on Twitter today. You can, with regards to psychology, you can have the best studies, you can have the most money, but I think the one aspect that has to be on top is psychology. When it comes to yourself, you have to know yourself, because that's something that can break everything you think you knew. You can be a Harvard graduate, you can be a millionaire, but psychology, if you're not on top of your game, I mean, it can destroy everything you think you knew.
Yeah, and I would just add to that I think that the most important psychological attribute for an investor is humility, because you can be right for the first 25 years of your career as an investor, and if you arrange a portfolio in a certain way, you can just be wrong during that last year and it can wipe out everything that you did. There are not many fields where that's the case. You know, if you're an athlete, whatever your accomplishments are leading up to a certain point, they're your accomplishments. They're yours. No one can take them away from you. You can have your investment gains over the last 25 years taken away from you in a day or a minute if you use leverage, if you go into some very complicated financial instruments. So you do have to be constantly vigilant. I struggle with it. I think every investor does, but it does keep you humble.
Yeah, no, for sure. I have this question for a bit later, because the last 2 years have been exactly that. You could have been right for a full year and a half and thought you would be the best investor ever. And then suddenly, 2022 happened and suddenly you think, I was completely wrong. And on the flip side, you could have started investing at the start of the year, and maybe 10 years from now, you would see and look back and say, it was a good move. But up until now, 11 months later, you feel like a fool. But we're going to come back to that a bit later. I want to touch one more time on the anti-fragile portfolio or way of investing. What would you say is the biggest weakness of it?
Well, I think that the thing that bothers people the most, so there's two, and first I'll get the thing that bothers people the most is that it does not consider valuation, because I believe that valuation is by far the most important thing over the short term. And by the short term, I mean anything less than 3 years. By far. Over the long term, and by the long term, I mean a bare minimum of 5, but preferably 10 years. Mm-hmm. What matters is free cash flow growth. That's really what it boils down to. And valuation matters much less over that time frame. So that is a weakness, especially if you're looking at it over a short term. But I will also say that the way that the framework is arranged is so that you can get a lot of false negatives. In other words, a lot of companies perform poorly on the framework and end up being really great investments over the long term. However, I'm willing to take that trade-off because over the long term, now over the short term, companies that score very well in my framework have done terribly over the short term, over the last year, basically. But over the long term, it has been rare that a company has done very well on the framework and been a really bad investment over a minimum of 5 to 7 years. Beyond that, measuring a moat and measuring optionality are subjective, but that's part of investing. There has to be a subjective piece, because if there wasn't, we would all just invest in the same things.
Of course. No, that's well put. Now, a bit more specific than we talked about the anti-fragile framework. So what are some of the highest conviction stocks you hold today? And maybe a small reasoning behind it.
I mean, by far, I'll say the largest holding I have is Mercado Libre. And I think what's special about it is that it clearly has optionality. It started out as a marketplace like eBay, and now is much more like an Amazon and PayPal and a couple other things all wrapped into one. They've got a lot of different moats. They've got the network effect for their marketplace. They've got switching costs for their payment tool. They've got low-cost production for their fulfillment. They've got brand value. And so they've got a lot of moats. They've got optionality. They're founder-led. They've got strong financials. So I'll throw that in there. And then I would also, the one that I always come back to is Axon Enterprise. And now this is the company that has body cameras and stun guns for police. But the real key is the software that they create to help them out. Software that can autofill paperwork, that can organize and help you search body camera footage. I don't see Pepsi to that Coke. I don't see a company that could take their business away. So that would be my other one. That would be a real high conviction stock.
Yeah. I think, well, Mercado Libre reported earnings yesterday, another tremendous quarter. And I think exactly, I wanted to give that example actually with Mercado Libre. Could have run it through the anti-fragile framework, let's say a year ago, would have scored pretty high, I think. But if you looked at it from a stock price perspective, it would probably have been down 40, 50% or so. Some would say, oh, you might be wrong. You must be wrong. But if you look at the track record of the company over the long term, I mean, it's a tremendous business, also in a huge growing market.
Yeah, it's so important. If you want to learn about how I use my framework, it's so important to, before you ever invest, to understand what your time frame is, because valuation is I mean, it really is the only thing that matters over the short term, and the quality of the business really is the only thing that matters over the long term. Doing that, voting for that David Gardner service that I voted for really taught me that and drove that home, because I would focus on valuation when I was starting that. And I still go back and look at my votes, and I see, for instance, there was a time where I had a choice between a company called 2U, which was an online education thing, and Amazon. And 2U had a much better valuation than Amazon when I was doing this voting. And nobody knows really what 2U is today. And Amazon is a multi-bagger sense, even if it had a much higher valuation. And over the 7 years, that's played out and continued. But you got to understand that, because it's hard to be patient to see that play out.
No, for sure. I think it's, again, going back to the psychology aspect, it's hard to imagine that big can become bigger. I mean, we've seen that with the mega caps in the United States. I mean, they can always become bigger and bigger.
Yes, it's mind-boggling, right? Because it seemed like crossing $1 trillion was such a big deal, and now Apple, it only took them 2 or 3 years to go from 1 to 2 trillion.
Yeah, for sure. I want to ask you, if you could choose one stock right now to invest in the next 10 years, only one, which one would that be?
I mean, I've got 3.
Okay.
Axon's one, and I've already talked about that. Beyond that, I would say Berkshire Hathaway would probably be at the top of the list. Not one that I'm invested in. But the thing is if you can only invest in one stock, if I can only invest in one stock, I'm switching my mindset from I want something that's going to continue growing to I want something that's not going to go down a whole bunch.
Yeah.
So that would be why Berkshire Hathaway would be at the top of the list. The only other one I would throw in there would be Alphabet or Google, because I think that they have a very solid business.
Okay. You mentioned Google, so advertising. I know maybe you still are a big fan of PubMatic. Is that still in the high conviction stocks? Because I'm sure that was also a high rating in the anti-fragile framework, but we all know the stock went, well, down quite a lot.
Yeah, and a whole bunch. Everyone who's involved in advertising is going down. Everyone who's involved in it. I see a very interesting thing playing out. And I'll tell a quick story. In 2007, Whole Foods was obviously the place to go for natural and organic food. And it's hard to remember that back then that wasn't so common. And Walmart, Kroger, Costco, they were just starting to get into that. But then the Great Recession hit and nobody wanted to pay for that stuff anymore. So Walmart pulled back, Kroger pulled back, Costco pulled back, and it was just Whole Foods. And they suffered mightily. The stock fell hugely. But they had no option. Their whole thing was natural and organic goods. So they had to stay with it. So they captured enormous chunks of the market, so that once the economy started to recover, they had the whole market to themselves, and their business did extremely well, and the stock did extremely well. Now, eventually, they didn't actually have a moat, because they can't tell all the farmers in the world, if you do organic, you can only bring it to me. They could go to Walmart, they can go to Kroger, they can go to Costco. But those dynamics are important, because I think that's what's happening in the ad space. So Pubmatic, as an example, people are spending less on advertising. There's no question. That should not be a question anymore. I mean, when Facebook and Google are seeing their ad dollars shrink, then everybody's seeing them that shrink. And that includes what's happening to Pubmatic. However, their share of the market is growing. Now, do we think that this pullback in advertising spend is going to last forever? No. I care about what happens between now and 2046. That's when I turn 65. Do I think that the advertising spend is permanently depressed until 2046? No way. I believe that Pubmatic, for example, is capturing more market share, so that when it turns, it's going to have an outsized portion of that growth. Now, does the company have a moat? I believe it does, but I thought the same about Whole Foods, so I could be wrong. We'll see how that plays out. But I think that the company is very anti-fragile. The stock and the company are very different things over the short term. And over the long term, they're almost exactly the same thing.
Yeah, very well put. I think it's true for advertising, but it's also true for other industries as well. Right now, we're seeing a pullback in a lot of segments. But again, if you're looking out 10 plus years from now, are we going to still be in the same situation? If yes, then my portfolio would probably be the least of my concerns. But if no, then today might be an excellent day to start investing, start looking into these type of companies. Now, I don't want to ask you maybe some specific, because leadership is probably one of the highest points on the lists of when looking at companies. So which leadership teams are executing the best in the current environment, and who are the most aspiring founder CEOs in your opinion? Can be retired one, can be current active ones as well.
Well, I mean, I think if you want to educate yourself, you could do a lot worse than to just go back and read all of Warren Buffett's letter to shareholders. Go back and find whatever you can that Charlie Munger has on YouTube. Go back and read Jeff Bezos's letter to shareholders. I think Jeff Bezos's letter
is a good one.
His letter to shareholders are phenomenal. There's so much good stuff in there. In terms of executing, I'll be honest, I know that he's probably the most polarizing figure out there, but when it comes to companies that are executing right now, today, in November 2022, I'd be hard-pressed to find a company that's not doing a better job than Tesla. I mean, their operating leverage, their demand, the fact that they spend $0 on advertising and marketing, I'd be hard pressed to find someone doing a better job than them right now.
No, I agree. I mean, it is my largest position. So obviously I've seen ups, I've seen downs, but overall I've seen more ups than downs. And I think that's probably the most important lesson in the long-term investing journey. You can see downs, but overall, even if you look at the overall market, over the long periods, you will see more up days than down days, which is why the market returns 9 to 10% on average. So there is that. Now, I want to go back to the question of the last 2 years. If there is something that retail investors specifically can learn from this period, because again, we've seen first the huge crash March 2020, then a huge recovery extremely fast, and then obviously right now bear market, recession, yes, no. So there are some lessons to be learned. So which one are probably the most important ones?
I think there's two. One, I'm considering whether or not I should work something about valuation into my framework. I haven't done that yet, but I'm at least thinking about it because this is painful for me too. And I'm a human being. I'm not a robot. It stinks. I think my portfolio's down, I don't know, between 50 and 60%. I mean, today alone, some of my biggest holdings are down by huge margins. At the same time, I think that the mindset of long-term investing is the most important thing to understand, and it's also the hardest thing to understand. And what I mean is this. Before I was a new parent, there were tons of people that talked about how I'd have less free time and how lack of sleep was going to get to me. But before I had a kid, I knew what they were saying. Like, I understood the words and I understood what they meant. There was no mystery there. But I had no idea what it was like to be a parent with no free time and going on 3 to 4 hours of sleep and trying to make ends meet. The reality of that was there's nothing I could do. There was no pill I could take. There was no class I could attend that would teach me what that was actually like. And it's the same thing with investing. It wasn't until I started investing actively in 2010, and it wasn't until 2015 or 2016 that I actually understood in my bones how long-term investing works. Before then, I was going based off of faith that David Gardner knew what he was doing, the co-founder of the Motley Fool. Since then, it's in my bones now, and I get it. And that is just a trial by fire that new investors need to go through. And so, channels like yours, channels like mine, I'm attempting to help do what David Gardner was able to do for me. And if I can do it only half as well, then I think I'll be doing a good job.
For sure. I mean, I started investing 2016, so I was 22 years old. And even though it's only 6 years, I mean, we've gone through a lot of weird stuff between 2016 and 2022. So it's a good learning period. Of course, it can hurt. I mean, probably all growth investors are down significantly, but over the long period, I mean, you're invested since 2010. I'm sure some of your positions are multi-baggers, if not many positions. So yeah, it's difficult. It's always hard to look at your portfolio, especially in bear markets, and see, oh, I'm down again today. I'm down again today. And then obviously with inflation, there's always this question, should I buy more? What should I do with the money, etc. But of course, number one lesson is don't invest money you will need soon. I think that's something everybody should know. And that really already make investing a bit easier, because the stress will be there, but at least it's less stress because you don't really need that money right now. Which goes into the next question. I'll just ask one. The best and worst mistake you've made?
The worst mistake I've made is when I get excited about a stock and I buy a lot of it to start out. That has happened with Peloton. That has happened with all the way back, Rosetta Stone. I didn't ease my way in. I found out about a stock. I did some research. I bought a lot of it. That has almost never turned out well. Almost never. The best mistake I've ever made was I forget what there are stocks that I have sold based on valuation a number of years ago, and they just keep going up. And that was when I was like, you know what? It's silly for me to sell just based on valuation if everything about the company, the human beings, and the thing that they're doing for the world I still like. Then that was a great mistake, because it taught me that, you know what, over that, if you're really a long-term investor, then that shouldn't bother you as much. Maybe pare it down a little bit, but not sell it completely based on valuation.
Yeah, it's funny because I've asked this question to a couple of people, and they all answer probably the same two. We've bought in way too quickly, and then we sold a good company too early just because it went up too fast, and then valuation was was too high. Myself included, the same with Nvidia. Bought early, which was okay, and then sold too quickly when it went up too fast. It's a good mistake. Obviously, it's better to have this than to buy and then drop 90% the next day or so. But it's lesson to learn, and I think most people would agree. It's just the way of the game in the long term. I'll end with a popular question from my viewers. What are the top 5 best books you would recommend to read?
I would suggest anything by Peter Lynch. I would suggest anything by Nassim Nicholas Taleb, especially Anti-Fragile. But I would throw in there Skin in the Game and Fooled by Randomness and The Black Swan. I think all of those are really important to investing in a future that we need to accept is unknown. And then I would also throw in the old school Motley Fool books about investing, Rule Breakers, Rule Makers, things like that. To be honest with you, I don't read inside of investing that much. I read outside of investing. So I don't have a ton of great recommendations for investing specific books.
And outside of investing, because I also read lots of more psychology and things like that. So you have
I mean, I would say anything by Mark Manson I like. He wrote The Subtle Art of Not Giving a Bleep. Yeah. I enjoy Ryan Holiday's work. He talks about stoicism. I'm also, this is completely unrelated, but I'm a huge fan of the authors Brene Brown and Glennon Doyle. Has nothing to do with investing, but I enjoy their books immensely.
All right. So there you have it. For those that are wanting to hear more about books, there you have the list. So I want to thank you for taking the time to come on and talk a bit about your investing journey. Everybody can find you on YouTube, Twitter. You have a Substack or something?
On YouTube, it's just type in Brian Feroldi's name. We started it on his channel and we just kept it there. On Twitter, I'm Brian_Stoffel_. And we do have a weekly newsletter. So not a Substack, but if you go to my Twitter profile, you can see the link for that newsletter right there.
Yeah, I'll link it in the description. There's also, if they want to follow along the progress of the anti-fragile portfolio on Stockart.
Yes, and you can follow that. Again, we started that about a year ago, so it's not pretty right now.
No, but who knows? In a couple of years, might look even better. And you still have a contest on there, because I still have one until the end of the year, and you have.
We have a contest. There's about a month and a half left, and maybe almost 2 months left. If you win $1,000, and I think that the leader right now is only ahead of the market, or ahead totally by like 10%. So there is a chance for someone to enter right now and still win.
Yeah, for sure. I have one as well, not 4,000, for 250, and the same thing here. Maybe right now could be the bottom, so who knows? Can enter late and win and take all the cash home. So again, thank you again for taking the time. Hopefully we can do this again sometime. Love your work, and I wish you a very good weekend.
All right, Neil, thank you very much.
Thank you. Bye.
All right.